Three of the most talked about stocks on Wall Street just did something almost nobody expected. In a single week, they clawed back 20% or more after months of brutal selling. Traders who had written off this entire sector are suddenly staring at their screens in disbelief. Billions of dollars flowed back into these names in just 7 trading sessions. And the strange part is, this isn't some random meme stock frenzy. This is quantum computing, the technology everyone said was still a decade away from mattering. So what actually happened here? Why did it happen right now? And more importantly, what comes next for anyone still holding these shares or thinking about buying in? Stick around, because by the end of this video, you will understand exactly what triggered this snapback, which companies are leading it, and what the smart money is watching for in the weeks ahead. And if you want more breakdowns like this delivered straight to you, make sure you like and subscribe before we get into it. Let's start with the setup, because you cannot understand a 20% bounce without understanding the fall that came before it. Quantum computing stocks had a rough summer. All 3 of the major pure play names listed in the United States cooled off sharply from the highs they hit back in late spring. One of them slid from the high 60, yes, down into the low 40s in just about 2 months. Another dropped from the mid-20s down toward $17. A third slipped from around $29 down into the low $20 range. That is not a small pullback. That is a sector getting cut down by roughly a third to nearly half its value in a matter of weeks. Retail investors who bought in during the excitement of the spring were sitting on painful losses. Analysts were writing cautious notes. Some commentators were openly asking whether the quantum hype cycle had finally popped. It felt, for a moment, like the whole story was unraveling. Then, almost out of nowhere, the tide turned. In the final week before this video, all 3 of those major pure play names rallied hard, each climbing roughly 20% or more in just 7 sessions. That is an enormous move for stocks with market capitalizations in the billions. When you see coordinated 20% weekly gains across an entire sector, that is not noise. That is a signal that something structural is shifting in how investors are pricing these companies. So let's break down exactly what is behind it, company by company, because each of these names has its own specific story layered on top of the broader sector tailwind. Start with the company that has become the poster child of the quantum computing boom. This business just delivered what its own leadership called its strongest quarter in company history. And it was the 5th consecutive quarter of record results. Revenue for the quarter came in at just over $80 million. That is a jump of roughly 287% compared to the same quarter a year earlier. To put that in perspective, this is not a company inching forward with modest single-digit growth. This is a business nearly quadrupling its revenue year over year. And it did not just modestly beat expectations, it blew past them by more than 20% above what analysts on Wall Street were forecasting. The company itself said the results came in about 20% above the midpoint of its own internal guidance, which tells you that even management was pleasantly surprised by how fast demand accelerated. Part of what makes this quarter so significant is a major acquisition that closed during the period. The company completed a deal worth roughly $1.8 billion to acquire a semiconductor manufacturing business. This is a serious strategic pivot. Instead of just being a quantum computing specialist that leases access to its machines through the cloud, this company is now positioning itself as a full-stack quantum platform, spanning computing, networking, sensing, cybersecurity, and now domestic chip manufacturing. That last piece matters more than people realize. Owning semiconductor fabrication capacity inside the United States gives this company a supply chain advantage and a national security angle that plays directly into government contracts and defense-related demand. Management has been explicit that this move extends their platform leadership across the American and allied technology ecosystem, which is corporate language for saying they want to be the default quantum supplier for governments that do not want to depend on foreign chip production. The customer numbers back up the growth story too. The company now counts more than 370 customers spanning government, commercial, and academic sectors. About a quarter of those customers are buying more than one product line, which shows the company is successfully cross-selling its platform rather than just landing one-off contracts. During the THC quarter, the company also published results from early development systems in partnership with major names in the chip and software world, demonstrating advanced error correction techniques that push beyond the older surface code methods that have dominated quantum research for years. This is technical progress that quantum insiders take seriously because error correction is widely seen as the single biggest bottleneck standing between today's experimental machines and tomorrow's commercially useful ones. There is another piece of this puzzle worth mentioning. A smaller but strategically important acquisition the company also closed during this period, expanding its networking and quantum security capabilities. Combined with the semiconductor deal, these moves show a company that is aggressively building out every layer of the quantum stack through acquisitions, rather than waiting years, to develop each capability organically in-house. That is an expensive strategy, but it is also a fast one, and speed matters enormously in a sector where being first to lock down enterprise and government relationships can create lasting competitive moats. Management has framed this approach as building the only true full-stack quantum platform and foundry positioned to serve the United States and its allies. Language clearly aimed at governments increasingly nervous about supply chain dependence on foreign semiconductor production. It is also worth rewinding a few months earlier in the year to another catalyst that first put this company back on investors' radars after a rough stretch. Back in the spring, shares jumped roughly 20% in a single day after the company landed a contract with the United States Department of Defense's advanced research arm, focused on building networked quantum computers that combine different qubit technologies into a single interconnected high-performance architecture. That contract was explicitly framed around strengthening national security by creating a backbone for networking and scaling quantum systems together, rather than leaving each quantum machine isolated on its own. At the time, despite that jump, shares remained depressed from prior highs, reflecting just how far sentiment had fallen across the sector during that earlier reset. It is a useful reminder that this stock, and this sector broadly, has already been through multiple boom and bust cycles this year alone, each one driven by a fresh wave of news rather than a smooth, steady climb. Now, it was not a perfect quarter across the board. Earnings per share on an adjusted basis came in slightly below what analysts expected, missing by a few cents. The company explained this was largely due to increased spending tied to integrating the newly acquired semiconductor business, along with pre-integration investments made ahead of closing the deal. In other words, the company is spending heavily right now to set up the next phase of growth, and that spending shows up as a short-term drag on the bottom line, even while the top line is surging. Interestingly, despite this blowout quarter, the stock actually closed down slightly on the day of the earnings report itself, before recovering in after-hours trading. That tells you the market had already priced in a lot of optimism heading into the print, and it took a few days of digestion before investors fully embraced just how strong the underlying numbers were. This stock carries a beta of more than 3, meaning it moves roughly 3 times as violently as the broader market in both directions, which explains both the brutal summer sell-off and the explosive snapback. Now let's turn to the second major name in this rally, a company that has taken a very different path built around on-premises hardware deployments rather than cloud access alone. This business reported quarterly revenue of a little over $5 million, which might sound tiny compared to the first company we just discussed, but the growth rate tells a different story. That figure is up sharply from less than $2 million in the same quarter a year earlier, meaning revenue nearly tripled year over year. For the first 6 months of the year combined, revenue came in at around $9.5 million, versus roughly $3 million over the same period last year. Gross margin also improved meaningfully, climbing into the low 40% range from around 31% a year ago, which reflects a healthier mix of higher margin system sales rather than just service revenue. The headline event driving investor enthusiasm here was a letter of intent with the United States government for up to $100 million in potential funding tied to the CHIPS Act framework. In exchange, the government would receive an equity stake proportional to the funding amount. This is significant because it signals Washington is treating domestic quantum hardware manufacturing as a strategic priority worth direct financial backing, not just research grants. The company also highlighted progress on its most advanced processor to date, a system built around 108 qubits, which is now generally available across multiple cloud platforms, including major names in enterprise. Rigetti Computing. 2-qubit gate fidelity, which is essentially a measure of how accurately the machine can perform its most basic operations, reached as high as 99.9% on prototype systems. That fidelity number matters enormously in this industry, because higher fidelity means fewer errors, and fewer errors means the machine can run longer, more complex calculations, before the results become unreliable noise. The company also expanded a collaboration with a major enterprise computing partner to supercomputing system at a research center focused on high-performance computing. This kind of hybrid architecture, where classical supercomputers and quantum processors work together on different parts of the same problem, is widely seen as the realistic, near-term path to commercial usefulness, rather than waiting for a fully standalone quantum machine that can do everything on its own. On the earnings call, leadership reiterated a roadmap targeting systems approaching roughly 1,000 qubits within about 3 years, alongside continued improvements in gate fidelity. Beyond the CHIPS Act letter of intent, The company also announced plans for international expansion, including a commitment of up to $100 million tied to overseas infrastructure investment, signaling that domestic government backing is not the only source of capital fueling its growth ambitions. Management has repeatedly emphasized that scaling toward 1,000 qubits requires not just better chips, but better cryogenic systems, control electronics, and manufacturing processes, all of which require sustained capital investment over multiple years. The company's willingness to commit to that kind of multi-year infrastructure build-out, even while still posting relatively modest revenue in absolute dollar terms, reflects a bet that being early and being ready when enterprise demand truly scales matters more than short-term profitability right now. There were some less flattering numbers buried in the report too. Operating losses widened compared to the prior year, and the net loss on a strict accounting basis came in significantly larger, though management was careful to explain that a big chunk of that increase came from non-cash adjustments tied to warrant and earn-out liabilities rather than actual cash burn from operations. On a non-cash adjusted basis, the loss picture looked considerably less dramatic. Cash reserves remain substantial, with the company holding several $100 million in cash and short-term investments as of the end of the quarter, and importantly, carrying no debt on the balance sheet. That cash cushion matters a lot in this sector because it buys time for the technology. Roadmap to mature without forcing the company into desperate financing at unfavorable terms. Insiders have been selling some shares over the past few months, which is worth watching, though insider selling alone is rarely a reliable standalone signal in a stock that has run up as sharply as this one has. One research note ahead of the earnings report flagged that the chief technology officer had disposed of a meaningful block of shares at prices well below where the stock trades today, which in hindsight looks more like a personal diversification decision than a signal of declining confidence, given how strongly the stock has performed since. Still, it is the kind of detail that disciplined investors track quarter after quarter, because a pattern of consistent, large-scale insider selling right into strength is a very different signal than a single isolated transaction. Heading into the earnings report itself, this stock had already rallied close to 27% over the prior week purely on anticipation, with the broader options market pricing in a large potential swing in either direction once results came out. That kind of pre-earnings run-up is a double-edged sword. It reflects genuine excitement building around the CHIPS Act letter of intent and the technical milestones on the roadmap, but it also raises the bar for what counts as a good enough result to keep the rally going. In the end, the combination of a solid revenue beat, expanding gross margin, and the government funding news was enough to keep buyers engaged even after such a strong run into the print, though the stock's reaction in the days immediately following the report was more muted than the explosive pre-earnings rally might have suggested it would be. Now to the third major name in this trio, a company built around a different underlying quantum technology approach, using magnetic field-based annealing systems alongside newer gate model machines, gained through a recent acquisition. This company's quarterly revenue came in at roughly $3 million, essentially flat compared to the same period a year ago. On the surface, flat revenue sounds like a disappointment, especially next to the explosive growth posted by the other two companies in this group. But dig one level deeper and the picture gets more interesting. Quarterly bookings, meaning new contracts, signed even if the revenue has not been recognized, yet rose by roughly 59%. That is a meaningfully stronger demand signal than the flat top-line number suggests, because bookings are often a leading indicator of where revenue is headed over the next several quarters. The company's net loss on a strict accounting basis actually narrowed significantly compared to a year ago, but again, much like the previous company, that improvement was largely an accounting effect rather than a fundamental shift in profitability. It stemmed mostly from a huge reduction in non-cash charges tied to warrant liability adjustments after the company redeemed its remaining publicly traded warrants late last year. Strip that accounting noise away, and you find that the adjusted operating loss actually widened by a wide margin as the company ramped up spending on product development and go-to-market expansion. Operating expenses nearly doubled year over year. Some of that spending is tied to integrating a recent acquisition of a gate model quantum computing startup, a deal that also accounted for a large chunk of the reduction in the company's cash position over the year. The company has also been building momentum around commercial partnerships, including a notable agreement with a major telecommunications provider, and continues to position itself as the only publicly traded quantum company offering both annealing and gate model architectures under one roof. That dual platform positioning gives the company flexibility to serve customers who want proven, currently deployable optimization tools through annealing, while also chasing the longer-term, more speculative gate model roadmap that companies like the first two names in this video are focused on almost exclusively. The core tension for this stock going forward is straightforward. Bookings are accelerating, and the customer pipeline is broadening, but none of that has yet translated into consistent quarter-over-quarter revenue growth, and the burn rate is climbing. Whether the roughly $40 million of remaining cash on the balance sheet, combined with future capital, raises is enough to bridge the gap until bookings convert into recognized revenue is the central question investors need to be asking about this name specifically. It is worth noting that heading into this earnings report, Wall Street had actually modeled healthy revenue growth and a narrowing loss for this company, based largely on optimism around the telecommunications partnership and an updated hardware shipment schedule expected to boost second-half results. The fact that headline revenue came in essentially flat against that backdrop was, on its face, a disappointment relative to expectations. Yet the stock still participated fully in this week's broader sector rally, which tells you that investors chose to look past the revenue miss and focus instead on the accelerating bookings figure and the long-term platform, positioning that comes from owning both annealing and gate model technology under one roof. That willingness to look past a near-term miss is itself a signal of just how much bullish momentum is built up across this entire sector right now, where good news gets amplified and disappointing news gets explained away, at least for the moment. So those are the three companies at the center of this rally. But the story does not stop there, because this snapback is happening inside a much bigger industry-wide narrative that has been building for months. One of the biggest catalysts sitting underneath this entire sector right now comes from one of the most established names in enterprise technology, a company that has been quietly positioning itself as the eventual backbone of the whole quantum industry. Executive said publicly that he expects the industry's partners to achieve the first genuine examples of quantum advantage sometime this year, using that company's hardware. Quantum advantage, in simple terms, is the moment when a quantum computer can solve a real-world, practically useful problem faster, cheaper, or more accurately than the best classical supercomputers available today. For years, quantum advantage has been talked about mostly in the context of narrow, somewhat artificial benchmark tests that had little real-world application. What is different now is the claim that these new demonstrations involve genuinely useful problems, verified through open, community-reviewed frameworks rather than closed-door corporate claims. In fact, just before this rally kicked off, that same company announced a joint demonstration with a quantum software partner, simulating a complex quantum material in a way that no classical computing method has been able to reliably reproduce, even after the challenge was left open to the broader scientific community for about 8 months. The companies involved described this as one of the strongest, most rigorously tested claims of quantum advantage published to date. This matters enormously for sentiment across the entire sector because it lends third-party credibility to the idea that quantum computing is transitioned in G from a pure research curiosity into a technology capable of solving problems that actually matter, whether that is designing better batteries, discovering new materials, or accelerating pharmaceutical research. That same company's leadership has also been talking up a longer-term financial vision, suggesting quantum computing could begin meaningfully contributing to revenue and profit by around 2028 or 2029, and ultimately unlocking something in the neighborhood of $1 trillion of economic value by the end of the 2030s. To back that vision with real capital, the company announced plans earlier this year for a standalone quantum chip. Foundry, backed by $1 billion commitment from the United States Department of Commerce through the CHIPS Act incentive program, matched by another $1 billion investment from the company itself. When one of the most respected names in enterprise computing puts $2 billion of combined public and private capital behind quantum chip manufacturing, that sends a powerful signal to every investor watching this space that the smart money believes this technology is inflection point close, not decades away. Beyond the quantum advantage demonstrations and the foundry investment, this company has also been steadily rolling out new generations of quantum processors as part of a multi-year hardware roadmap. Its most recent chip generation increased the number of tunable couplers by roughly 20% compared to the prior generation, a technical improvement that directly translates into the ability to run more complex circuits with more entangled qubits working together at once. As part of this roadmap, the company has published targets for the number of 2-qubit gate operations its systems can reliably perform, starting from a baseline in the thousands, and aiming to scale into the tens of thousands over the next several years. Each doubling of that gate count roughly corresponds to the ability to tackle meaningfully larger and more complex problems, which is why quantum researchers watch this particular metric so closely as a proxy for genuine technological progress, arguably more closely than they watch raw qubit counts alone, since a large number of noisy, error-prone qubits is far less useful than a smaller number of high-fidelity, reliably controllable ones. This company has also taken the unusual step of contributing to an open, community-led quantum advantage tracker developed alongside several independent research partners, specifically designed to let outside researchers test, compare, and attempt to disprove quantum advantage claims using classical methods. That kind of transparency is a deliberate strategy to build credibility in a field that has occasionally been criticized for overhyped claims that later failed to hold up under scrutiny. By inviting the broader scientific community to actively try to poke holes in its results, and by publicizing how long those results have withstood open challenge, the company is trying to marketing-driven claims elsewhere in the industry. For investors, this matters because it suggests the quantum advantage narrative currently fueling this stock rally rests on a somewhat more solid, independently verifiable foundation than some of the more speculative claims that have periodically moved quantum stocks in the past without ever being fully substantiated. There is also a chip and artificial intelligence angle fueling renewed enthusiasm across quantum names. Earlier this year, one of the dominant players in AI computing hardware introduced a new modeling approach specifically designed to help solve error correction challenges in quantum systems, one of the most persistent obstacles blocking the path toward reliable, large-scale quantum machines. When a company with that much influence over the AI and data center world starts actively contributing tools to solve quantum's hardest technical problems, it reinforces the narrative that quantum computing is becoming intertwined with the broader artificial intelligence and high-performance computing boom, rather than existing as some isolated niche experiment. It is also worth zooming out to see just how broad this rally has been beyond the three biggest pure play names. A smaller quantum company focused on photonic reservoir computing technology surged after landing an initial purchase order and framework agreement for its hardware platform, with an initial order covering several systems and a potential path toward a much larger multi-million-dollar program if future orders follow. Another emerging player working on quantum-enabled testbeds saw its stock rise well over 200% in a single week, driven by investor excitement around a new quantum testbed using trapped ion technology supplied through a partnership with one of the sector's larger names. Yet another quantum technology company saw a similarly explosive move, surging more than 200% over 5 trading days as investors piled into the broader theme rather than picking just one winner. When you see this kind of coordinated buying across half a dozen or more quantum-related tickers at once, from the smallest microcap names all the way up to the billion-dollar leaders, that tells you this is a sector-wide repricing of risk appetite, not an isolated story about one company's earnings beat. Let's dig a little deeper into a few of those smaller names, because they help explain just how far this enthusiasm has spread. The photonic reservoir computing company we mentioned a moment ago is a quantum optics and photonics business that has been building specialized hardware for tasks like signal processing and pattern recognition, applications that sit slightly outside the traditional general-purpose quantum computing story but still benefit from the same wave of investor interest. Its stock climbed more than 10% in a single session after confirming its initial order and framework agreement, with the potential scope of that agreement eventually expanding to as many as 100 systems and a total program value above $10 million, assuming future orders actually materialize as hoped. That last caveat matters because framework agreements and letters of intent are not the same thing as signed, binding purchase orders, and the gap between the two has tripped up plenty of speculative stocks in the past when anticipated follow-on orders failed to show up on schedule. The company building quantum-enabled testbeds that surged more than 200% in a single week represents an even more speculative corner of this trade. Its rally was driven almost entirely by investor excitement around a planned second testbed location using trapped ion hardware, supplied by one of the sector's larger, more established names. In other words, part of this smaller company's stock move was really investors expressing enthusiasm about a bigger company's technology, filtered through a much smaller, more thinly traded vehicle, which naturally amplifies the percentage swings in both directions. Moves of 200% in a week are the kind of thing that grab headlines and social media attention, but they also tend to be far more fragile and far more likely to reverse sharply than the more measured, earnings-driven rallies we saw in the three major pure-play names at the center of this story. There is also a British quantum security company in this broader basket, along with a Canadian quantum photonics business, both of which have seen their shares swing dramatically over the past several months as part of this same broad theme buying pattern. Large technology names outside the pure play quantum space are relevant here too, since major cloud computing and enterprise technology companies continue investing heavily in their own quantum research programs. Continued progress or funding announcements from those bigger players tend to lift sentiment across the smaller, more speculative names that depend on partnerships with them for credibility and distribution. Before we get into the risk side of this story, it is worth taking a step back for anyone newer to this space and quickly explaining why quantum computing is even worth this much attention in the first place. Traditional computers, The ones inside your phone or laptop process information using bits that are always in one of two states, either a 0 or a 1. Quantum computers instead use quantum bits or qubits, which, thanks to the strange rules of quantum physics, can exist in a kind of blended state representing something closer to both a 0 and a 1 at the same time, and can also become linked together in ways that let changes to one q by t instantly affect another, no matter how the system is arranged. For certain very specific types of problems, particularly ones involving huge numbers of possible combinations, like simulating how molecules interact at the atomic level, optimizing complex logistics networks, or breaking certain forms of encryption, this strange quantum behavior theoretically allows a sufficiently powerful quantum computer to explore far more possibilities simultaneously than any classic L supercomputer ever could, no matter how many classical processors you throw at the problem. That theoretical advantage is what all of this investor excitement is ultimately chasing. The moment when that theoretical edge becomes a practical, repeatable, commercially useful reality rather than just a laboratory curiosity. Now, before you get too excited and go all in on this sector, let's talk honestly about the risks, because there are real ones, and any serious investor needs to understand them clearly. First, and most obvious, these companies remain deeply unprofitable. Even the company posting the most impressive revenue growth in this entire group is still recording net losses when you strip out one-time gains. Cash burn across the sector remains substantial, and while balance sheet-esque currently look healthy thanks to strong cash positions built up through prior capital raises, that cushion will not last forever if losses continue to widen at the current pace. Eventually, several of these companies will likely need to raise additional capital, either through new stock offerings that dilute existing shareholders or through additional debt, and the terms of those future raises will depend heavily on where the stock prices sit at the time. Second, valuations across this sector remain extraordinarily stretched relative to actual current revenue. One of the three major names in this rally is trading at a price-to-sales ratio in the hundreds, meaning investors are paying an enormous premium relative to the company's current annual revenue, essentially betting almost entirely on a future that has not arrived yet. That kind of valuation leaves very little room for disappointment. If a single quarter comes in below expectations, or if a major contract gets delayed, these stocks can give back weeks of gains in a single trading session. Exactly the kind of violent swing we saw during the summer sell-off that preceded this current rally. Third, insider selling has been notable at more than one of these companies over the past several months, with some executives disposing of meaningful blocks of shares even as the stock price recovered. To be fair, insider selling can happen for all sorts of personal financial reasons that have nothing to do with a lack of confidence in the business, but it is still a data point worth tracking alongside everything else, especially when it happens right into strength rather than during weakness. Fourth, and this is probably the most important structural risk of all, the technology itself is still genuinely early stage. Even the most optimistic executives in this space, including the enterprise technology leader we discussed earlier who was talking about quantum advantage happening this year, are still targeting large-scale, fully fault-tolerant quantum computers only by around 2029. That is still years away. Near-term demonstrations of quantum advantage, however impressive and however well verified, remain narrow proofs of concept rather than broad commercial platforms capable of running any workload a customer throws at them. The gap between a headline-grabbing scientific demonstration and a dependable, revenue-generating commercial product remains wide, and investors chasing this rally need to be honest with themselves about how much of the current stock price reflects actual near-term cash flow versus pure long-term optionality on a technology that could still take much of the next decade to fully mature. Fifth, there is real competitive risk from directions that are easy to overlook when you're focused only on the pure-play quantum names. Some of the largest technology companies in the world, including major cloud, computing providers, and enterprise hardware giants, are running their own significant internal quantum research programs, and several of them have far deeper pockets and far more diversified revenue streams to fund those efforts indefinitely, without needing to worry about quarterly cash burn the way a smaller, pure-play quantum company does. If one of those larger, diversified players achieves a major breakthrough first, or simply decides to compete more aggressively on price for cloud-based quantum access, that could put meaningful pressure on the pure-play companies that depend entirely on quantum computing for their entire business model. At the same time, classical computing itself keeps improving too, and some of the most useful near-term applications currently being marketed as quantum breakthroughs are achieved using hybrid approaches that lean heavily on classical hardware alongside a smaller quantum component, which raises legitimate questions about how much of the value creation in these early use cases is actually coming from the quantum portion of the system versus the classical portion doing most of the heavy lifting. Sixth, regulatory and geopolitical risk deserves a mention too, given how much of this sector's near-term growth is tied to government contracts and national security spending. Defense and intelligence agency budgets can shift with political administrations, and export control policies around advanced computing technology have already reshaped parts of the broader technology sector this year. Any significant change in how governments prioritize or fund quantum research, whether due to budget constraints, shifting political priorities, or international trade tensions, could directly affect the pace of contract awards and funding commitments that have been such an important catalyst for several of the companies discussed in this video. So, with all of that said, what actually comes next for these three stocks and for the sector as a whole? Analyst sentiment right now is leaning notably bullish, at least on two of the three major names. The market leader by revenue currently carries overwhelmingly positive analyst coverage, with the vast majority of covering analysts rating the stock A buy and essentially zero sell ratings on record, alongside a consensus price target that sits meaningfully above where the stock is trading today. That gap between the current share price and the average analyst target suggests Wall Street's professional research community still sees further upside from here, even after this week's sharp rally, assuming the company continues executing on its growth trajectory and successfully integrates its recent acquisitions. The on-premises hardware-focused name also carries a consensus price target implying substantial upside from current levels, with analysts split between buy and hold ratings but very few outright bearish calls. The key swing factor for that stock in the coming quarters will be whether revenue recognition from its growing order backlog accelerates as expected, and whether the government funding letter of intent converts into an actual signed, finalized agreement with real dispersed capital attached to it, rather than remaining a preliminary commitment on paper. Consensus analyst price targets on this name currently imply meaningful upside from levels seen just before this week's rally began, which shows how much skepticism was already priced into the stock, even before the recent bounce, and how much room analysts believe still exists if the company keeps executing well on its roadmap, and if the pending revenue recognized from its existing order slate flows through cleanly over the second half of the year. For the third company, the one built around annealing technology with flat recent revenue but surging bookings, the near-term story is really about proving that demand signal translates into actual recognized revenue growth over the next 2 or 3 reporting periods. If bookings growth of nearly 60% starts showing up as genuine revenue acceleration rather than remaining stuck in the pipeline, that stock likely has room to reprice higher alongside its peers. If it does not convert, this could end up being the laggard of the group, even as its two larger peers continue attracting the bulk of investor attention and capital. Zooming out across the whole sector, the single biggest catalyst everyone in this space is watching for over the coming months is further independent verification of genuine quantum advantage claims, expanding beyond the initial demonstrations we discussed earlier into a wider range of practically useful problems. Every additional credible, peer-reviewed demonstration adds another brick to the foundation supporting these valuations. On top of that, watch for additional government funding announcements, since the CHIPS Act framework has already shown a willingness to back quantum hardware manufacturing with hundreds of millions, and in some cases billions, of dollars in direct capital commitments. Any signal that this kind of government backing is expanding to additional companies in the sector could trigger another leg higher across quantum-related names broadly. It is also worth remembering just how quickly sentiment in this sector has flipped before, and likely will again. Go back further than this summer's sell-off, and you will find that quantum stocks have already lived through several distinct boom and bust cycles over the past couple of years, each one triggered by a different catalyst, whether that was a major technology company announcing a new quantum chip, a government agency signing a headline contract, or a wave of retail enthusiasm around the broader artificial intelligence theme spilling over into anything perceived as next-generation computing. Each cycle has followed a fairly similar pattern, a sharp run-up driven by genuine news mixed with speculative excitement, followed by a period of consolidation or outright decline as the market digests just how far the story has run ahead of the underlying fundamentals, followed eventually by the next catalyst restarting the cycle all over again. Recognizing that pattern does not mean this current rally is guaranteed to fade, but it does mean investors should approach each new leg higher with a healthy dose of pattern recognition rather than assuming. This time, the move will simply continue in a straight line without any further volatility along the way. Also, keep a close eye on customer concentration and contract announcements. The strongest performing company in this group has been explicit that a meaningful share of its revenue now comes from customers purchasing multiple products across its platform. And that kind of expanding wallet share within existing customers is often a healthier growth signal than simply landing new logo customers one at a time. Watch for similar cross-selling data. Points from the other companies in the sector as evidence that quantum platforms are becoming genuinely sticky within enterprise and government technology budgets rather than one-off experimental purchases that could easily get cut in a tighter spending environment.